SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Good afternoon and welcome to this SUERF Baffi Bocconi webinar. Our topic today is the repo market. This is the market for secured borrowing, and it currently accounts for around 3.5 trillion in the euro area. The repo market used to be sort of a technical niche topic for quite some time, at least before the global financial crisis, but it has now gained prominence, as we also see from the quite sizable attendance of this webinar. The main two reasons for why the repo market became more and more interesting are, first of all, the interbank unsecured market, so the market where banks lend to each other without collateral, has gone down in size or is almost disappearing. And second, the repo market also plays quite a large role in the funding of government debt trading. And so given the sizable amounts of government debt issued not only in the US, as we repeatedly see, but also in the EU and in the euro area, this is also a reason why the repo market became more and more important. The problem, or one of the main challenges with the repo market, is that it is inherently fragile because it is not traded on exchanges, but rather among dealers. So large banks trade repos among each other, and we have seen in the past 10 years a number of stress episodes, particularly in the US, but also in the UK. So the repo business of these major banks has quite a lot of parallels to standard banking business. The banks, these dealer banks, large banks, take cash, for instance, from money market funds. So this is a bit like a bank taking deposits, and then they lend this cash to, for instance, hedge funds or other banks. And for this, so this is then the lending side, the banks take on collateral. So it's always secured funding, and the funding is typically secured by, at least in the EU and in the US to a very large degree, by government bonds. So there are, as we are going to discuss in the webinar this afternoon, there are two important factors in the functioning of the repo market. First of all, the ability of banks to handle all these flows, so the capacity the dealer banks have on their balance sheet. And second, of course, also the amount of government debt issuance which needs to be handled. Another important factor in the functioning of the repo market, and this is also something which we are going to discuss in detail today, is monetary policy, the operational framework, and the monetary policy stance. So this also has a sizable impact on the repo market. And to discuss these topics, we have here 4 senior experts from the private sector, but also from the public sector and from academia. And for the start of the panel, I will now hand over to our chair, to Anneli.
Thank you, Martin. Thank you so much. And good afternoon also from my part. I'm really happy that we can organize this webinar this afternoon on this very topical issue. And I'm even more happier that we have all these distinguished speakers with us this afternoon. First, we have Christoph Rieger, who is Head of Rates and Credit Research at Commerzbank AG. He has extensive experience in fixed income research. He holds degrees from University of Cologne and Temple University Graduate School. Second, we have Tobias Linzert, is head of cross-market analysis and intelligence division at the ECB. He joined the ECB in 2005 and has held several management positions in the areas of monetary policy and market operations. He has numerous publications on financial markets and monetary policy, and he holds a doctorate in economics from Goethe University. Paddrik is Associate Director in Financial Institutions at the Office of Financial Research. He joined the OFR in 2013. His research focuses on market microstructure, central clearing, financial intermediaries, and stress test design. He holds a doctorate in systems engineering from the University of Virginia. And Angelo Randaldo received his doctorate from the University of Freiburg in 2000. He worked in the private sector and the Swiss National Bank as economic advisor and member of senior management in 2004. Since June 2022, he is senior chair at the Swiss Finance Institute. During his career, he has worked with the Bank of England and the ECB, which awarded him a Wim Duisenberg Fellowship. He has published numerous articles on financial economics in leading academic journals, particularly in the areas of asset pricing, international finance, and market microstructure. What we are going to do today, we are going to have 2 rounds of panel, and after that, our panelists are more than happy to answer your questions that you can post in the, you can have in the chat function. But I would now like to start with the panel. So may I start with you, Christoph? So you have been actively leading analysis on the repo market at one of the major market participants. So what are your observations on the topics raised by Martins?
Well, I think he described it really very well, and we agreed actually that I should also provide a brief summary of what the repo market is all about. And yeah, I think I really don't have so much to add, but maybe the only thing how I would describe it is maybe the way actually our former head of liquidity trading summed it up. Liquidity is the oil in the engine, right? If we don't have the repo market, there's no bond trading. And if we need to raise more and more public debt nowadays, we cannot do this if there is no trading. And this is why I think Martin was absolutely to the point. It is now really crucial to understand this market and also for you guys and the official sector to make sure with us that it works well. So yeah, basically what I intend to do now over the next 10, 12 minutes, and I promise I'll be brief because the fellow panelists that will follow, especially from the ECB or the US Treasury, they sit on a gold mine of data that we can all only dream of. And so what I can do is provide you the market perspective. So yes, we can observe market pricing, and we have, I think, also good data on individual bond repos, GC, especially in the overnight market. But once it comes to term trades, or especially once it comes to the less liquid collateral, basically we're almost blind, to be fair. And yeah, this is why I just now want to provide you a bit of a glimpse in terms of how we look at the market and what we've observed over recent years as the ECB has gone from quantitative easing towards quantitative tightening. And then also a few words on the more recent developments actually, and perhaps then also some thoughts on what may lie ahead. I mean, going from QE towards QT, this chart basically summarizes what happened in the repo markets. It shows you from the 4 large Euro government bond markets, the number of bonds and how special they were trading. So 2 or 3 years ago, you can see that almost the entire universe was trading special, especially if you would just do this exercise for bonds, you could see that in the middle of 22, almost the entire market was extremely special, 70, 80 basis points through Esther. Now, the more recent history, where you see this larger gray area, actually shows you that the bulk of the market right now is actually trading above Esther. And we even have this red area, which basically is the bracket where we have repo levels more than 10 basis points above Esther. So this means that the market is even trading above the ECB deposit facility rate. Clearly, yes, the ECB footprint was very central in this market moving from collateral scarcity towards the collateral abundance that we have today. But there were a number of other factors as well. I think one very important factor that we cannot ignore when we're discussing the repo markets are the hedge funds. Why are the hedge funds so super important for the repo markets? Well, a hedge fund, in anything they do, they need the repo markets because they need to fund their positions, be it whether they're long or whether they're short. And especially in the recent years, quite clearly, just speaking to our traders, it was very obvious that they are running increasing long positions. So not like 2 or 3 years ago when they came to us and basically needed to fund short, so they were looking for paper and gave us their cash. Now this is completely reversed, and we're in a situation right now where actually they're tendering us the paper and they're looking for funding. They're looking for the cash. And this, I think, explains why, right now also the repo rates relative to, say, Esther have increased recently because of this imbalance that has started to build up in the market. By the way, also last fall, we've had, as usual, ahead of year end, quite some anxiety, and this time I would say more than usual. And then this was quite a good example where you could see developments from the repo market spilling over into the broader bond markets when actually bonds versus swaps sold off very significantly as these hedge funds all of a sudden were getting worried that their funding over year end actually would not work as it was expected. And I think this highlights why the market is still quite vulnerable if we have a lot of material that needs to be funded here on an overnight basis whilst the supply keeps picking up. With this, I would already maybe just one chart on the magnitude of the hedge funds for the German market. Here on the left-hand side, you see the net buying from these accounts in the secondary market accumulated. Admittedly, a bit overstating the absolute levels because it doesn't include maturities, but still you get the message. Basically, what I was saying earlier from observations at the trading desk, you can see it here in the data as well. So they were significant net buyers, especially last year on the right-hand side, you see in 10-year area, they were by far actually the biggest net buyers. Now, a different representation of the chart that I was showing you earlier is actually this here, where I'm just showing you 3 different repo spreads, GC, general collateral, the yellow line, and then 2 different measures for specials trading. And basically when the lines are above 0, this shows you that the repos were special. So the repo rates were below the Esther rate. And well, as you can see, more recently, we have GC, but also most of the special bonds below 0. So that means that their repo levels are actually above the unsecured rate. I think this is already one important message from this chart that you would also see or have seen in the first chart I was showing, that I'm sure we can also discuss later in this panel, because it is, of course, quite an unusual observation to see a rate secured by German government bonds at higher levels than a presumably more risky unsecured rate. What other observations are there now in the more recent history of our repo markets? Well, if you look at those 3 lines, what do you see? Well, actually not a lot, right? Despite really major fundamental changes taking place, the repo market was extremely stable. So for instance, when Germany announced its massive spending plan, which we think will amount to over 1 trillion over the next good decade, the market did nothing. And one reason for that, by the way, is, as we've discussed earlier, the whole repo market is basically an overnight market. Yes, there are 1-year German GC trades, which show you that there is some expectation of even higher repo rates, but the market there is a lot less liquid compared to this very short-term market, and this is why, yeah, at least in these short-term repo rates, we're not seeing any movement despite the massive changes that are coming. And so we really need to wait for the supply to arrive before we can then see the impact happening. The other thing is, I mean, when we had the turmoil in the US Treasuries market, which also spilled over to some extent, but in a different manner than to the German Bund markets, again, you see nothing, right? So the market was extremely stable. And here also, I think this sends you an important message, because there were a lot of stories that there were big rotations out of US Treasuries into anything else, including bonds. So say that there was massive Chinese buying of German government bonds. Well, if this would have been the case, then you would have clearly seen that the market would get more special, because at some point, yeah, this cash has to get invested somewhere, which means the dealers are getting short, they need to cover, then the repo rates basically are falling. We've not seen any of that. So this is, I think, also a good indication that so far probably a lot of things have clearly happened in the US Treasury market, as we'll hear later on, but in the German Bund market, a lot of it, at least, has been rather focused on the futures market. Now, finally, I want to attempt a little bit a look also ahead in terms of what we are expecting. And here's one chart basically showing you, well, two things. One is the black line, which is actually fairly easy to estimate. You need some assumptions, but not a lot. The excess liquidity in the Eurosystem, which is on a declining trend as the ECB reduces its balance sheet. Now, these shaded areas, they show you the borrowing from banks at the ECB, which is still at relatively low levels, but expected to pick up. And this increase, basically this projection going forward, this is not my own forecast, but this is taken from the ECB's survey of monetary analysts. So basically, yeah, experts, median expectations of how basically the short-term and the 3-month borrowing from the ECB will evolve going forward. Now, it is quite interesting to see that actually already over the next few months, and certainly by next year, there is quite a swift pickup in borrowing activity about to take place. Now, probably the more difficult question still to answer then is why should banks borrow to such a large extent? And then related to this, of course, what will happen during this time period in our repo rates, or in our repo spreads, I should rather say, which could be one reason clearly for banks to use more ECB borrowing. Because right now, even though, yes, repo rates are above Ester, and some even are above the DFR, the ECB deposit facility rate, none of them are, at least in the liquid bond markets, are trading at more than Depo plus 15. So that means that actually the market funding is still a lot cheaper than the ECB funding. There is, however, another motivation that banks could use to use the ECB borrowing, and perhaps this is also reflected in these expectations of a pickup already this year. And this basically has to do with borrowing from the ECB to improve your regulatory ratios. And if you, for instance, wanted to fund unliquid collateral, which basically you could not fund in the market, and you can basically fund it at the ECB at 15 basis points above the depo rate, this may be very attractive because you can create HQLA and thus yeah, improve your liquidity ratios. And Yeah, I'm sure we'll discuss then in a minute as well, because I'm running against my time limit pretty shortly now in terms of the motivation behind banks of doing these sort of trades. And one important question that clearly plays a role there is the stigma, right? Because right now we're seeing very little borrowing, even though, like I said, for some certain balance sheet management reasons, it would be economical, even, I would say, for banks to come to the ECB and borrow. And we're hearing that, the one side of the ECB, at least, say, Tobias or Isabel, they tell you, listen, our operations are there to be used. There is no stigma. Please come. We're open for business. But then there's the second element also in the ECB and also the rating agencies, of course, where, well, banks are being asked, well, if market rates are actually below ECB rates, why are you borrowing from the ECB, right? And so I think this is still a very important question that needs to be addressed now. When will be the level where banks will actually come to the ECB? And now in terms of what does this mean for rates, in a sense, the way I like to see it is, I mean, it's almost like a chicken egg problem, right? The ECB has, I mean, well, banks would love to get these structural long-term borrowing operations rolled out that the ECB has promised, but they will only actually be rolled out, well, once the balance sheet of the ECB starts growing durably again. So once basically we start borrowing also in the short-term markets. And for this, probably first, we need to also see a further pickup in market rates, so that then, more banks will then say, okay, we are going to the ECB for good economic and not just balance sheets, ratio reasons. And this will then, I think, clearly mean also, higher rates, but certainly more volatility in the repo spreads than the one that I've just shown you in my earlier charts. Yeah, and with this, I'm already a little bit over my time allocation for my first intervention. And then I would like to please hand over to Tobias.
Thank you, Christoph, for your extremely clear and good presentation. And of course, I mean, what you said about the rates was extremely interesting, of this stigma impact, of the fact that unsecured rates trade below secured rates. And then also maybe during the second round, you could a bit sort of elaborate on the hedge funds, because as you said, they need the repo market. But are there any implications that might be for the bond and repo market functioning because of the high hedge fund participation? So would be interesting topics to hear. But then next, Tobias, now we are continuing to face challenging times for monetary policy and its implementation. We are very interested to hear your views from a Eurosystem perspective, and what is the role of recent changes of the operational framework? Please, Tobias.
Thank you very much, Anneli. Okay, so let me maybe indeed pick up a little bit on a few points that Christoph just made, and talk a little bit about the repo market amid the declining Eurosystem balance sheet, and especially focusing a bit on how banks behave in the repo market, how they adjust to the decline in excess liquidity. And also, as you just said, Anneli, in the context of the new operational framework that we announced in March 2024, and especially in light of the new pricing that we announced for our operations, and that came into play on 18th of September with the 15 basis point spread in the MROs and 3-month LTROs over the DFR. And I will be taking a little bit a very individual bank perspective, so drawing a little bit on the gold mine data that Christoph mentioned, and see a little bit how indeed how we can track banks through the market, through the money market, through their money market behavior, but also how they appear in our operations. So now. So on this slide, I'm just showing the Eurosystem balance sheet, and what you can see, of course, is that it's on a declining path after the repayments of the 3-month of the TLTROs. That's the blue area, and the gradual decline in our monetary policy portfolios. And what you can see is that excess liquidity, the red line, has declined by roughly 2 trillion since the peak in November 2022, and standing currently at around 2.9 trillion. But it is expected, and that you see in the projection, it's expected to decline further to roughly 1.8 trillion by the end of 2026. Now, the message from this picture is, of course, that at the aggregate level, excess liquidity in the euro area is still very ample. But this aggregate picture, of course, masks some heterogeneity that we looked into based on a survey that we ran with bank treasurers. And we asked those bank treasurers, how much reserves would they like to hold, and what levels of regulatory requirements they target. And so we could, in the end, link that to the individual bank data that we have, and the excess liquidity holdings that banks actually have. And we now could categorize banks according to how far are they from their preferred level of liquidity, of reserves, and their, if you want, self-imposed targets also for regulatory ratios. And what you can see on the left-hand side chart is that roughly 17% of banks are operating already close to their desired levels of reserves, but of course that the overall majority of banks is still holding ample reserves. However, and that you see in the green and in the blue area, there are a number of banks that are operating actually close to their internal LCR and NSFR targets. So that's to be really clear. So it's not the regulatory LCR and NSFR levels, but it's basically what banks themselves would like to hold as in terms of LCR and NSFR ratios. And again, some of those banks are operating close to those internally set targets. Now, with this in mind, what we did, we started looking how this this also unequal or uneven liquidity distribution affects banks' behavior in money markets and in our operations. And so let's maybe have a look at the repo market, and more at the aggregate repo market developments. And Christoph already just showed the chart where you can see that indeed the repo rate has approached, has been increasing and has approached the deposit facility rate. But what you can see is that, overall, of course, rates are well behaved. They are well anchored around the DFR. But again, especially the repo rate, has come closer to the DFR and is showing the spread to also Euro STR that Christoph alluded to. Now, what we can now look at is, to what extent or what are the underlying drivers of these developments. And indeed, what Christoph also mentioned, I mean, the main driver, of course, is that the Eurosystem has a much smaller market footprint, which means that there is a lot more supply of government debt out there that is not bought by the Eurosystem, and that of course has to do with both the decline in our balance sheet, so that the Eurosystem is running down its balance sheet, but also that of course governments have increased their net issuances. And you see on the left-hand side slide a chart that of course these developments go very well hand in hand with this increasing in the euro repo DFR spread. Now on the right-hand side chart, we zoomed in basically on also the chart that Christoph showed, namely on what part of banks are trading above DFR and which are below DFR. And when you again zoom in, and you see this in the red area on the right-hand side chart, when you zoom in into the trades above the DFR and look at who are those banks, we see that these are not the reserve scarce banks, so not the banks that are operating already close to their desired levels of reserves, but it's mainly abundant reserve holding banks that are close to also LCR and NSFR targets. So these are the big banks, these are the big dealer banks that Christoph mentioned, and not the reserve scarce banks. So that shows us that the increase in the repo rate is not driven by reserve scarcity, but it is rather driven by the vanishing collateral scarcity in the market. At the same time, we do see that the banks that are closer to their reserve target are active in the repo market. So you see this in the yellow part of the chart, and you see that indeed those banks that are closer to their desired reserve level are net borrowers in the repo market. So they go to the repo market to borrow reserves. But of course, what you can also see, of course, in this chart is that the overall volumes and these borrowing amounts are still rather limited and small. So it's around 55 billion. It's 2.4% of total assets of those banks, of the banking system. So it's a rather small share yet of the repo market, where again reserve bank or reserve scarce banks are trading. But it shows us, and maybe closing with this slide, at least with a positive message, is that the repo market does act as a let's say as a redistribution mechanism also of from let's say reserve abundant banks to more reserve scarce banks. Now turning to maybe more what's happening on banks' liquidity with regard to their let's say also regulatory ratios. What we saw is that of course with the TLTRO repayments, banks HQLA or reserves or share of reserves in their HQLA went down, but we saw that banks try to keep LCR levels rather stable, and they try to keep those internal LCR targets, compensating for the reduction in reserves by market sources. So holding more government bonds, but also more L2 securities like covered bonds and so on, replacing, so to speak, the share of reserves. Now, that of course tells us, and also going a bit back to what Christoph mentioned, at this stage, No, banks are very much using market sources to fulfill their regulatory ratios. They turn to the market. They don't turn to our operations. I'll come back to that later. But they turn to the market to fulfill their regulatory requirements. We see this also in the following slide, where banks indeed, satisfy term liquidity demand in the commercial paper market, but also in the term repo market to improve their regulatory ratios. And what we also see is that banks are actually willing to pay a premium also in the market for that type of liquidity. And you can see in this chart that while for using non-HQLA collateral in the term, in the repo market, that's so transforming non-HQLA collateral into HQLA eligible reserves. The premium in the segment of 1 to 3 months is just below the MRO rate of 15 basis points. But when you look further out in the curve, banks are paying a premium on receiving that type of liquidity with regulatory value. And maybe just closing, because I'm running out of time, maybe just closing with a brief look at our operations. And Christoph already alluded to that the pricing in the market is still rather attractive. And we have here this chart that also shows that both, let's say, when we look at the overnight and also the 3-month liquidity, the market pricing is still below the 15 basis points that we have in our MROs. And so, of course, there is indeed very little incentive right now for banks to turn to our operations. At the same time, and I think that's the key dimension, of course, to mention, it's not just the pricing, it is basically that aggregate excess liquidity is still very, very abundant, and therefore banks, of course, also do not need to turn to our operations. And that's what you see here in the last chart that also Christoph had, where the overall amounts are still very tiny, and again, of course, are expected to increase in the future, and we can maybe discuss further also on that in the second round of discussion. So let me close here. Thank you very much.
Thank you, Tobias, very much for the very good presentation where you elaborated on the players and their behavior, and also the bank's willingness really to turn to the markets. But talking about markets, so let's go to the US markets. So Mark, the US repo market shows some structural differences to the setup of the Euro area market. It has also recently faced several major stress episodes. So we look forward to hearing from you about the US market and the role of dealers. Please.
Thank you very much, Itch, and I appreciate the question, and I'll try to do my best to reflect on some of the differences I have observed between the two systems. So to give some perspective on the relative importance of the US repo market, it ultimately, in a very similar setting, it provides a high degree of funding to the overall financial system. As of today, we observe around 7 trillion in new funding being produced on a daily basis. This facilitates not only liquidity within the system for the transfer of cash for securities, but also the facilitation of the liquidity of those securities markets that are used for collateral, such as US Treasuries. Now, the US market is basically constructed of 4 segments, and this doesn't mean that these segments are completely independent of one another by all means, but they serve different purposes and different clients. And to this effect, US dealers, primarily banks, but there are non-banks in here as well, will help facilitate the transfer of cash and collateral across these 4 segments, and helping to close the gap between funding demands and collateral transfer. Now, in doing this, dealers perform rehypothecation and collateral transformation, and they face very similar, maybe some might say almost traditional banking-like risks in order to help complete markets. That's such as collateral transformation, maturity transformation in those repo transactions, and differences in counterparty risk on either side. So to give a quick overview of what does the U.S. market look like, there roughly are 4 segments. These segments are broken down based off of whether the collateral can be centrally cleared in the repo transaction. And so this ultimately means GCF and DVP markets. These are segments that can clear U.S. Treasuries and other government securities versus non-centrally cleared in tri-party-ins and CCBR. The other split is whether the settlement is done on general collateral or bilateral. And in general collateral, we have a tri-party system for the majority of those types of transactions, which are intermediated in the U.S. at this point by a single institution, the Bank of New York Mellon. So recently, of these 4 segments, 3 of them have been collected either by a Office of Financial Research or at the New York Federal Reserve. But most recently, we've helped to collect the final of these 4 segments with the non-centrally cleared or acronym NCCBR. I'm presenting here just a sample of these 4 segments based off of a collection and pilot collection that we did in 2022. But as of now, we do collect all 4 segments and hope to make more of that data regularly available to the public through our short-term funding monitor. So to give you a sense as to the 4 segments and their general size, as you can see here that the majority of the cash coming into the repo market is coming from the tri-party. This is where generally money market funds and other cash-rich and counterparty risk sensitive firms traditionally participate for bringing cash, and they bring those to the majority of dealers or banks. That cash is then and it's done through a general collateral system, which is primarily treasuries, but as well as other securities. And that cash is then redistributed, and much of the collateral actually come from the other segments, as you see here, the green bars of the reverse repo that dealers face is used to facilitate the collateral that they're using to post against the cash that's deposited against these. So in this particular setting, and we're looking at roughly just over $1 trillion of these 9 pilot participants. But as I said earlier, there's roughly $7 trillion in U.S. transactions done daily, and nearly $10 trillion in outstanding repo that's outstanding on any given day at this point. So what do dealers ultimately do? Well, what they're doing is going to these segments to facilitate their using collateral from one segment into another segment and helping to intermediate on one of these counterparty risk dimensions to help complete the markets. And ultimately, the reasons for their need for this may be due to differences in maturity needs of cash lenders versus cash borrowers, or it may be due to counterparty risk thresholds that some institutions may not be able to face certain counterparties directly. Now, what does that ultimately mean when we look at this particular sample here? So if we translate this total volume and think of a dealer's balance sheet as being the amount of collateral coming in through these rows and the collateral being redistributed and up through these columns here, we can get a sense as to how these markets ultimately connect to one another. And so from this work, we see that at roughly 65% of aggregate at reverse repo, or 44% of aggregate repo, is rehypothecated. So the collateral that's coming, say, from a hedge fund is perhaps making its way to a money market fund ultimately in order to facilitate that cash. Of that, 90% into US Treasuries is by dollar volume, but on a transaction basis, it's typically much more of other or smaller forms of securities. But the remainder of that, which we see here as the balance, ultimately relies on the fact that dealers must take on some securities and do a collateral transformation of some variety. Now, perhaps they're taking those securities that they receive through a reverse repo, and they're using it as part of their market making function, or they may just be placing it on their balance sheet and replacing it with collateral that is more or fungible or acceptable to those that have cash and are only willing to lend against certain types of collateral. Now, another type of risk transformation is maturity. And if we look across all the segments, and rather at the segments themselves, but rather looking at the maturity transformation that's occurring across these, once again, reverse repo on the rows and repo out the columns, we see that the 60% of total volume in this segment is typically matched relatively closely. As you can see, in particular, overnight makes up the majority of the total volume that's matched on a rehypothecation basis. Yes, but there is also traditional borrowing short and lending long, as we would think of as a traditional banking type exercise. While there are in the gray, there is the opposite transformation occurring as well. I won't speak to what these ultimately mean in terms of value spreads. I can tell you that typically in all these transformations, the banks are able, on average, to make a positive spread. Now, the last transformation of counterparty risk, which is not typically thought of in this setting, but once you have this sort of holistic view, one can actually now get a better appreciation for how dealers are able to facilitate each other. So looking at the rows associated in columns of broker dealers, there's a lot of intermediation of collateral that they do with one another, perhaps because of differences in customer base and collateral demand that they can help for one another. But also, interestingly, it shows us things that we wouldn't normally think about, as in, for example, hedge funds and HF here, or much of the collateral that hedge funds deliver in reverse repo actually are then used and delivered back to hedge funds of another variety. Now, I won't speak to necessarily those types of transactions and what those trades are, but it shows you that in the event that there might be turmoil of some variety, that the spillovers are not necessarily what appreciated to how some institutions are connected to one another indirectly through dealing institutions here. Also interesting thing to point out, I think, is the amount of collateral here that's coming from hedge funds that actually are delivered into money markets and mutual funds as well. So I'll conclude there and look forward to any questions that you have. But I do want to highlight that when we think about risk in repo markets, it's not just about pure liquidity considerations, which have been of note in the last few years, particularly in the US in September of 2019, in considerations of concern, but also just traditional transformation risks such as collateral, maturity, and counterparty risk. Thank you.
Thank you, Matt, very much for the very good presentation on the structure of the US markets and also your elaboration on the different risks regarding transformation risk. But let's now turn to our last speaker, Angelo. You have a background in central banking as well as in academic research. We are very interested to hear more about your analysis of the repo market and collateral, and how do you see the resilience of the repo trading? The floor or screen is yours.
Thank you very much, and thank you, the organizers, for inviting me to participate to this distinguished panel. So the overall question I would like to address indeed is whether the repo market, the Euro repo market, is good, right? If it's of good quality. And, you know, typically academics are seen as quick to criticize, always bothering people with annoying technicalities. Today I might disappoint you because I'm going to argue that actually I have a positive view of the repo market, and I believe it's actually pretty good and resilient. And this already showed up in our first systematic study when we studied the Euro repo market infrastructure, and we showed that the repo market features efficient pricing, promptly adjusting, say, the demand and supply shifts, and also it's even a shock absorber when it comes that is secured by very safe collateral assets like the German bond, right? On the left-hand side, you see the schematic view of the Euro repo market. And you see in the core of the Euro repo market, the vast majority of trades are centrally cleared. And so then we compare this market design with other market design, including the US one, and we concluded that there are three key features contributing to the quality of this market. First is indeed the central clearing. Second is the use of relatively safe collateral assets. And third is that the trading is happening in anonymous trading platforms. So all these characteristics significantly reduce the risk, especially the counterparty risk, making the Euro repo market very resilient. And as Martin pointed out at the beginning, that was also crucial when we had the migration, the shift from the unsecured European money market into the secure one. And that was a study that we did at the bank level with Mario Di Filippo and Jan Brampenmeier at the time. And on the left-hand side, you see how the volume shift from the unsecured to the secure segment. And at the bank level, indeed, the riskier banks benefited most from this shift, allowing them to borrowing in an anonymized way, as long as they were able to pledge securities. And second, they keep on lending, refraining from hoarding liquidity in crisis period, right? Why? Because they don't need to hoard liquidity for precautionary reasons, because they were able to lend in a very safe market. So overall, this speaks in favor of the quality of the market, of the Eurosystem market. And now I would like to spend a few words about a key characteristic, a crucial characteristic of the Euro repo market, which is the heterogeneity of the collateral assets. So this is a distinguished characteristic of the Euro repo market. We have so many different government bonds and other assets. And indeed, in a study with Benedict Ballensiefen, we demonstrated that there are two key factors to price Euro repo contracts. The first, if you want, is the market level factor reflecting the general level of repo rate. But the second, which is the key one, is what we call HML, which is highs minus lows, this capture the cross-sectional dispersion in the repo rate. So when you use only these two factors, you are able to explain nearly the whole cross-sectional temporal variation in the repo rate. Now, the key question is then where this dispersion is coming from, right? So there are various sources of dispersion in the repo rate. Here in this study, we show that the different degrees of market quality and the scarcity of the collateral assets are key drivers for the repo dispersion. In particular, the scarcity induced by the ECB quantitative easing led to a steady decline in the corresponding repo rates. As illustrated in the chart in the left, right, repos backed by quantitative easing eligible assets in the blue line traded at significantly lower rates than non-eligible ones at the green line. In addition, another important factor is the access or not to the ECB deposit facility. So this, when an institution has no access, face different funding conditions, right? We can, especially during the period when the repo rates were hovering below the ECB deposit facility rate, banks without access were actually lending at higher rates than the banks with access. So paradoxically, these no-access banks traded at rates more aligned with the ECB policy rate, thereby contributing more to the monetary policy transmission than banks with access to the facility, the ECB facility. Then another important driver of the repo dispersion is the regulatory framework. Right? The schematic view on the right-hand side illustrates how the Basel III leverage ratio penalizes repos, but not reverse repos. Why? Well, because repos expand the size of the balance sheet asset through the cash received, while securities, collateral securities, remain on the asset side of the balance sheet. This results in a penalizing leverage ratio for those banks, right? Because of this, and because of this leverage ratio regulation is calculated as calculated as a snapshot at the quarter end balance sheet positions, banks were incentivized to reduce the repo activity around those dates, resulting in periodical, predictable rate drops as shown in the picture on the left-hand side, right? So, and notice that this regulatory distortion spilled over into other important funding markets. In a recent study, we show with Peteris Klocks and Edouard Maty, we show that European banks hunting for dollars via US repos systematically switch to FX swaps at the quarter end. Why? Because FX swaps are not subject to the leverage ratio regulatory constraint, right? So on the left-hand side, you see how European banks systematically reduce US repo borrowing. And on the right-hand side, you see that at the same time, they increase synthetic dollar funding using FX swaps, right? So regulation is a very important driver. And in a recent study, we demonstrated that there is an additional important regulatory effect coming from the EMIR regulation. We call it that collateral cycles. This is a study with Evangelos Benos and Gerardo Ferrara, right? So there is a significant distortion from the EMIR regulation. You see here, there are central clearing houses here depicted in this schematic view, right? So under the EMIR regulation, CCPs are required to retain no more than 5% of the cash received as initial margin, right? So as a result, they tend to return this cash to the market, primarily using reverse repos. Of course, CCPs have two more alternative options to do that. They could actually purchase a safe bonds outright or depositing cash at the central bank if they have access to. However, the reverse repo option is by far the most attractive and more flexible way to do that, to fulfill this regulation requirement, right? So what they do, that every day, the CCPs, you see with the black arrow here, return cash into the repo market with a significant effect. We call it that backward phase of the collateral cycle. Then there is also an onward phase here, coming from the clearing members that actually they are aware of this. They know that they have to fulfill the margin calls issued by CCPs, and these margin calls are, of course, procyclical in the sense that they increase with market volatility. So to meet this requirement, clearing members raise cash typically through CCP-based repos, right? So they go to the repo market, raise cash in order to fulfill the CCP initial margin requirement. And we show that this procyclical cash demand from clearing members actually create an upward pressure on the repo rate, right? So this is an important fact that people are less aware of, and we think that the regulation created a new big player in the repo market, and those are indeed the CCPs themselves, right? So I would like to conclude then with opening questions that we haven't answered yet in the academic literature, right? And at this point, you might think, well, wait a second, didn't the presenter, this Angelo, started by saying that the repo market works so well, and why now he has been focusing on so much on many frictions, including regulation, right? Indeed, I never claimed that the repo market is perfect, right? But it's important to recognize both its strengths and frictions. And there are many important questions remain open. I think, for instance, who is trading in the repo market and why, especially non-banks. We know little about that. And the previous presenters also mentioned hedge fund and so on. And second, how efficient and risky is the bilateral non-CCP Euro segment? It's way under researched, and I think we need to study more. And I conclude with a recent study of from Edouard Maty, a PhD student that I have supervised. In the job market paper, he studied in a clever way the shift of the European bond settlement time, right? Given point in 2015, it was one that the bond market in Europe changed from T+3 to T+2, and this was a natural experiment to identify market participants relying on repos to fulfill the delivery obligations of fixed income securities. And you can see here there was a sudden shift from the spot tomorrow to tomorrow next segment, indicating that 30% of participants they were using repo market to ensure the timely settlement of the fixed income asset. So with this, I'd like to conclude. Thank you very much.
Thank you, Angelo, so much for the very comprehensive presentation, which you started with a very positive tone, saying that you have a positive view of the repo market and it is resilient. You also listed some positive features, but then you were slightly more critical, talking about repo rate dispersion, and argued that the Basel III leverage ratio distorts repo markets, and also told that the distortion of EMIR regulation. Anyway, so we have now completed the first round, and I very much urge our audience to post questions in the chat. And I already noticed that there are some questions, and especially now there's one question directed to Christoph. So why don't we start a second round where you can also challenge each other's interventions or comment on them or praise them, whatever is your appropriate view. But Christoph, would you like to start?
Yes, very happy to do so. Yeah, let me try to answer this $1 trillion question that Jens has asked in the chat. Basically, when will rates start to rise, at which level of excess liquidity? Now, perhaps Tobias can also comment on this, because I know the ECB has an army of people trying to analyze this, especially when it comes to the operational target, which is the ESTR, the unsecured rate. Now, for the repo market, certainly the evidence that has now been presented in the latest ECB block or the money market study underscores that some close to 20% of banks that are close to their targeted reserves are using the repo markets already, right? And if you then look at how the excess liquidity is distributed by country, it's obvious to see that in particular Italian banks are at the lowest level. So this is plain to see that they are the ones who will then also first more actively be using the repo markets. And yeah, whilst we are still clearly also in BTP repos below the DFR plus 15, I would imagine that this activity would then lead to a more gradual upward move, first in the periphery repos, and then also in the core markets, to a level where I don't think we will quite get to the plus 15, where we'll get more volatility, but we will also be moving higher, because the one thing is, yeah, the liquidity that banks need to raise in the repo markets. And the other thing is then still the supply side of the collateral, which, yeah, just continues to go up and needs to be basically channeled through the plumbing that is available, where it is not clear whether dealer balance sheet activity in the repo markets will grow in sync with what may be needed there as well. And so I think all of these arguments argue for further gradual upward move in repo rates. And then the question is just whether the unsecured will follow. But what we've seen right now, and I think also the good analysis that the ECB has presented on this, is market are structurally different, right? And especially the trading desks are located in different areas in the banks, and this may lead to, yeah, some divergence, so that repo rates actually can move up, whilst this doesn't have to happen to the same extent in the ESTR, the unsecured.
Is there anything else you want to comment on the
Sorry, I just didn't get the last point because there was a bit of a...
Okay. Is there anything else you would like to comment on regarding the other presentations made by
Yes, maybe
panelists?
maybe one point also that you raised in the beginning, basically how vulnerable could the market be, given also, you know, the market participants that we've seen emerge and the increasing funding volumes that need to be basically channeled through the market. One point that we haven't really touched upon is the economics of the repo trading right now, and I have a feeling that we could be facing somewhat of what may be called a pig cycle. You know, when there was a lot of specials in the market, there was a lot of volatility. It was of course quite attractive to also engage in EGB high liquid repo trading. By now we have hardly any specials left, and so it is very difficult to make money just pure EGB repo trading. And this is clearly, I think, one aspect where, together with some of the regulatory constraints that may be coming into play, where banks are facing larger counterparty risks, where they may have to resort to standard model approaches, so that basically, the cost of providing the balance sheets to these activities is not getting any less. I think this is clearly something that we also need to keep a close eye on.
Did you hear me? Thank you. So what about Tobias? Do you have comments?
Yes, thank you, Anneli. Maybe I can also pick up on this question of let's say, where's this famous point where banks reach, if you want, their preferred reserve levels, and what would that imply for money market rates? Now, I think one important point maybe to make in this regard is that the ECB went for a demand-driven system, in the sense that our refinancing operations, the main refinancing operations, are open to banks. They can demand whatever liquidity they want if they bring adequate collateral. So basically, if there is, if you want, reserve scarcity, or if banks would like to hold more reserves, they can always come to the ECB and they can receive that liquidity with a 15 basis point spread over the DFR. So I think that's very important, and that distinguishes us also very much from, if you want, supply driven frameworks, for example, at the Federal Reserve, where you supply the market with reserves and you would like to supply the adequate amount to preserve money market rates at the floor. So I think that's a very important distinguishing feature, where in the end that point in time is somewhat endogenous to our system, where banks will then come and will demand the reserves they need. Now, the key question is indeed to what extent that would have an implication on rates with the 15 basis point spread of the MRO over the DFR. And I think that depends, and I think the jury on that is out, and it's very difficult to pass a judgment at this point in time. It will very much depend on, indeed, the attractiveness of our operations vis-a-vis, for example, market funding. When banks would come to our operations and hold indeed a little bit more reserves than they would actually need, and therefore that would compress money market rates at the DFR. But of course, you can also envisage a scenario where indeed, market rates again would move closer to the MRO, given that the MRO is the marginal price of reserves. But in the end, it really depends on how banks will judge the attractiveness of those operations in the future, and to what extent they are used, and that will imply what money market rates then will do. So I think at this point in time, I don't think we will know exactly what money market rates, where money market rates will evolve. And in the end, the intention, of course, of the operational framework that was decided last year was, of course, to preserve the DFR as the key policy rates, and for money market rates to be, anchored around that DFR rate. So maybe that's on the first point. Maybe on the point that was also raised, how does the repo rate behave in relation to the unsecured rate? And I think, and also the if you want, the mystery that Christoph mentioned, that a secured rate is now trading above an unsecured rate. And I mean, to a big extent, that of course has to do with the fact that the unsecured market is a market for storing deposits of banks or of entities that do not have access to the central bank balance sheet with entities that have access to the balance sheet. So that's, I think, the key factor. But in addition, I think there are a number of, if you want, specialties in these two market segments that explain why there is this spread between the two rates. The first is regulation, and I think Angelo also mentioned the leverage ratio that is constraining. But it is constraining more in the unsecured market than in the secured market, because in the secured market, with the possibility of netting if repos are traded vis-a-vis CCP, of course, alleviates these regulatory costs. So I think that's one factor. And the other factor is, of course, that there is a bit of market segmentation between the two markets in terms of who is also active in these two markets. And what we see for, of course, the unsecured market, that there are smaller entities in that market segment that also do not have access to the repo market. So that whole, if you want, arbitrage relationship that you would like to see from the two market segments just does not happen, because the players in those two markets are just too separate. So I think these are two important points. And I'll stop here. Thank you.
Thank you, Tobias. Thank you so much. And then Mark, and please also pay attention to the questions in the chat so that they all will be answered. Okay, so Mark, please.
Let me reflect on a number of things other panelists in the chat have mentioned. So I think under the current setting of that, we all agree that there's going to be more collateral, all that needs to find a place. There breeds new opportunity and new arbitrage activity that entices many more market participants into the system that necessarily were previously, who were just seeking perhaps cash funding solely. So that has, I think Angelo pointed out very nicely with the FX example, that opportunities like this, where there's balance sheet and accounting rules that make repo an opportunistic venue to help complete an arbitrage trade, is one reason, and that we certainly should be interested in the sense of whether particularly very levered institutions and who are using repo to obtain that leverage. I think from the perspective of market completeness, this central clearing is certainly a very, very important under a setting where you have a growing market and concerns of liquidity. And so any opportunity that both members and clients are able to more directly interact with one another in a central forum rather than having to rely on intermediaries is in as many places as possible. That's useful. Well, it's also very useful from central clearing from the perspective of Tobias also raised, is the regulatory capital needs, and to be able to reduce that, to increase the ability of intermediaries today to be able to do more of that intermediation. And how easy that's to do when you have a lot of different types of collateral is certainly part of the challenge here, and the degree of centralization of that clearing aspect of the problem. So I think those are the sort of areas I think would highlight as the opportunities for the forward-looking guidance that we see of the need for facilitation of collateral and its use in funding markets in order to perhaps make a safer environment that is more flexible to the variation demands with a wide variety of financial institutions participating.
Thank you, Mark, for your words. And then, last but not least, Angelo.
Well, I don't have much to say. I think maybe three things impressed me during this panel. One is the sophistication of the data, the granular data that at the moment policymakers, but also private institutions have in hands, right? This signals that there was a lot of improvement in monitoring the market, in understanding the market, which is, I think, very welcome. The second is that I was impressed by the growth of the US repo market. Mark pointed out 7 trillion. I think within few years, there was a substantial increase. Maybe Mark can tell you more about that. And yet, despite this increase, despite this sophistication, despite the new market participant that we have discussed today, being hedge fund, but also the clearing houses themselves, as I pointed out. I mean, despite all this, the market is still well functioning, but evolving every day. So there is a lot of effort here to understand this market. This was what impressed me during this panel. Thank you very much.
Thank you, Angelo. And what impressed me was your expertise and your very clear presentations. I'm sure that the audience very much agrees with me, and I'm very happy that you participated in the panel. And now I ask Martin to say a few words at the end.
So also from my side, thank you very much also for the interesting questions. The repo market has so many different dimensions as we tried to highlight, and there are not only the structurally interesting questions, but also the impact of monetary policy. So we really tried to cover as many of these topics as was possible within these 1.5 hours. And we are planning another webinar in September on the government bond market. So basically we then move from talking about the repo market to the functioning of the government bond market. And of course, this will then be also announced on the website of SUERF, and we are pretty sure that some of the themes and also some of the questions will be picked up in the next webinar then in September. So thank you very much also from my side, and have a nice afternoon from Frankfurt.
Thank you.
Thank you. Bye-bye.
Bye.
Thank you. Bye-bye.